A sudden 2-week ceasefire just deleted a historic spike in global oil prices, and Wall Street is completely rewriting its playbook for the rest of 2026. We are seeing a massive shift from geopolitical survival mode straight into pure economic realities. Welcome to Coffee Break Capital. Financial markets move fast, but we move faster. Sit down, take a sip, and let's get you caught up on the numbers that matter today. Today, we are breaking down the market into two clear pictures: the good news pushing stocks higher and the harsh realities hiding just beneath the surface. Let us start with the bullish side of the market. The single biggest story of the week is the rapid de-escalation in the Middle East. Late on April 7th, the United States and Iran, mediated by the government of Pakistan, agreed to a 2-week ceasefire. This agreement includes the immediate reopening of the Strait of Hormuz under Iranian military management. This specific waterway is an essential choke point for global crude oil transportation. The stock market reaction was instant and deeply positive. Japan's benchmark Nikkei 225 surged 4.8%. South Korea's Kospi gained 5.6%. Here in the United States, futures for the S&P 500 advanced 2.3%. This relief is acting like a direct stimulus check for the American shopper. The National Retail Federation recently forecast that United States retail sales will grow by 4.4% in 2026 to $5.6 trillion. A drop in energy costs ensures that households can spend their money in the broader economy instead of burning it at the gasoline pump. Moving into corporate growth, the first quarter 2026 earnings season is officially kicking off, and expectations are high. Goldman Sachs reports on Monday, April 13th. Analysts expect year-over-year revenue growth of 12.9% for Goldman Sachs, reflecting a revival in investment banking. JPMorgan Chase and Wells Fargo follow up with their reports on April 14th. On the technology front, all eyes are on the Taiwan Semiconductor Manufacturing Company, known as TSMC, which releases its March 2026 sales data on April 10th. TSMC controls a massive 72% global market share in the foundry market. Their combined sales for January and February showed a 29.9% year-over-year increase. A strong report for March will prove that the artificial intelligence growth trend is fully intact. Before we look at the darker side of the market today, if this breakdown is helping you navigate the chaos, hit that subscribe button right now. It helps us keep you ahead of the curve. Now, let us pivot to the bearish realities currently challenging investors. While the broad market loved the ceasefire, the energy sector crashed hard. United States WTI crude oil futures sank 14.3%, down to $96.83 per barrel. Brent crude dropped 13.3% to $94.74 per barrel. This drop forces analysts to lower their forward earnings estimates for major energy companies like BP, which had been expecting 22.6% earnings growth based on higher commodity prices. But the most systemic risk is hiding in our own domestic monetary policy. The dream of multiple interest rate cuts this year is fading fast. JPMorgan Chase's chief U.S. economist has issued a forecast predicting exactly 0 interest rate cuts by the Federal Reserve through the entirety of 2026. Even worse for borrowers, JPMorgan predicts the next move will actually be a 25 basis point rate hike in the third quarter of 2027. Why is this happening? The U.S. labor market remains historically tight, with the unemployment rate sitting at 4.4%. An unemployment rate of 4.4% is widely viewed as too strong to justify lowering rates. Furthermore, the United States core CPI is projected to run hot at an average of 3.2% in 2026. Federal Reserve Chairman Jerome Powell has explicitly warned that without sustained progress toward the 2.0% inflation target, projected rate cuts will be abandoned. This higher for longer reality is devastating for rate-sensitive sectors. Expect 30-year fixed mortgage rates to stay entrenched above 6.00% throughout 2026 and into 2027. This paralyzes the housing market and damages forward revenue projections for home builders like Lennar and D.R. Horton. We also have physical risks in the tech supply chain. TSMC relies heavily on energy imports, with natural gas making up nearly 48% of Taiwan's electricity generation. There is also a global shortage of helium, which is required for semiconductor cooling systems. Finally, we are watching the Hungarian parliamentary elections on April 12th. Prime Minister Viktor Orban has actively blocked a €90 billion EU loan package for Ukraine. If he remains in power, institutional gridlock in Brussels will continue. Here are our predictions based on the data. Whenever interest rates stay elevated for longer than expected historically, we usually see large-cap financials and cash-rich companies outperform, while debt-reliant small-cap businesses struggle. Look for banks to report expanded net interest margins. Keep a close eye on your exposure to interest rate-sensitive sectors and watch those TSMC numbers on Friday. This information was compiled from various sources across the internet and is not intended as financial advice.